When the economic environment becomes uncertain, we provide the truth from a breadth of perspectives to help people make decisions. We not only compile and analyze the data that moves our ever-evolving economy, we carefully craft our own to provide clarity across industries, businesses, and employment markets. We identify unique opportunities to deliver asymmetric returns and focus on capturing value created during periods of higher volatility, transforming the financial landscape together. We're MacroEdge.
Good afternoon, everyone. This is John Galt speaking, and welcome to MacroEdge Radio, number 19. We have a spectacular program, because it says so in the description and the title, a macro spectacular, as we've had a lot of data to digest since I've been gone for a week. And I've also sat there and had to address some other issues after my brief vacation, watching and listening to the markets, to the media, and to the circus. We're not going to talk politics tonight, although it is a wide open program. Tonight we have two special guests. One, Mr. Ulysses Ozone, part of the MacroEdge team. We're going to be discussing the real estate market and some new data that he's developed, charts that are going to come in quite handy that you will be able to obtain on the MacroEdge website. We're also going to have a special guest on who is finishing up his market wrap program. That's right, the one, the only, nobody special, Jade at JG Nuke, Jack from the Doomer News Network. He has been on this for a long time, and we really appreciate him taking some time out. If you haven't watched his programs on YouTube with Melody Wright and Travis, they are fantastic. They give you a lot more insight into the housing markets, the economy, etc., from a different perspective. Now, I like to think that I can outdoom them, but sometimes they give me a run for my money. When we're talking about today's markets, this was an absolute circus. Dow finished up about 427, NASDAQ up 207, S&P 500 up 53. Volume right now is abysmal, probably will continue to be abysmal. We had a massive distribution event around 11 o'clock this morning where somebody sold a heck of a lot of stock, got under their Gulfstream, flew to St. Bart's and said, here, junior traders, don't mess this up. And that's how this rolls. What you don't understand now is on these weak technical days, the markets can be moved by small players with play money from the Monopoly Bank. And that's all that you're going to see for the next week. Probably the Wednesday after Labor Day is when reality starts to come back in. And that's when we'll see the real players return and begin their deal as far as reallocating assets, making sure that they have some degree of certainty with what the Federal Reserve is going to do, and worst of all, what the government's going to do. They have to predict political events because while a lot of these people you see on FinTwit, financial Twitter as we call it, bet on the short term, the day, the hour, the week, the money managers have to bet on the quarter, the half year, and the year. And this is where it gets interesting. This is where the markets really move when billions of dollars are shifted around. And where have we seen billions of dollars shifted around? The bond market. People don't want to hear that. They don't want to hear about the bond market having massive moves because it's called the smart money for a reason. Well, the smart money has been flashing warnings for months, as all of us have been warning. But the closest parallel to the federal funds rate is the 2-year Treasury, not the 10-year. The 10-year is for long-term interest rates. The 2-year is closest parallel to what the Fed funds rate should be. Today, it dropped almost 10 basis points to 391.3. You always go to 4 digits if you want to sound like you know what you're talking about. And that is a flashing red warning for everyone. We are witnessing the markets trying to tell Powell that you're too little too late. And he's caught in a box. If we get a good unemployment reading, and a week from next Friday, he can't cut 50 basis points. However, if the things that are bubbling up under the surface that we're going to talk about in today's program come to the surface, we will witness a desperation cut, which will panic the markets, panic the larger economic picture, and worse, start to interfere in the political situation, the election of 2024. Joining me now is Ulysses Ozone. Are you ready, sir?
I am. How you doing, John?
Pretty good, Ulysses. This has been a fascinating couple of weeks watching the markets from afar. What do you make before we get into the talk about the new home sales report today? Boy, do I have a lot to say about that, but I'll let you go first.
Yeah.
What do you make of the overall economic picture starting to come into focus?
I think we're starting to see people wanting to change their positioning, in stocks and assets. And I think people are beginning to, especially after today, expect the Federal Reserve is going to start cutting rates. Maybe Jay Powell has been reading MacroEdge.
Uh, or maybe he's been over in Janet's Mushroom Kitchen, because
That's also possible.
yes, because my consensus on this is that he's being held hostage, and there's some very good articles that have been published recently showing where the Federal Reserve is being held hostage by the political elites, the House, the Senate, and the
Sure.
presidency. And now that they've issued this much debt, and it's magnifying and amplifying not just annually but monthly, the amounts are growing larger, and the intake from income tax, from corporate taxes is declining slowly, mind you, but it's starting to decline. They're going to have to get pretty desperate and start funding the government indirectly, which before anybody says that's QE, folks, we've been doing QE since 1926. This is nothing new, but it's the level and degree and openness of it that's going to really scare people. Where do you think this is going to lead as, one, the housing economy slows down, and two, and I'm going to bring our guests on here in a minute, two, what do you see as the impact next year on the economic growth projections? Because nobody has a good picture on 2025.
Sure. Well, this is, I guess, part and parcel of the problem with using rates as a blunt instrument. The economy doesn't turn on a dime, right? Imagine it like a giant ocean liner. It takes time for it to come to a stop. It takes time for it to turn. And once it does begin turning, again, you don't just stop that on a dime. It continues to turn. So I guess I can use that as an analogy. I don't necessarily think that rate cuts are going to create the soft landing situation that other people are calling for. I think the momentum is going to carry through at least another couple quarters, and um, the economy at large is moving in the direction of recession, whether we like it or not. All the signs are pointing in that direction, in my opinion.
Well, let's bring our guest on, at JG Nuke on Twitter, X, the famous Nobody Special. Love that name still to this day. The one and only Jack from the Doomer News Network, who participates with our very own Melody Wright, and Travis with great weekly broadcasts. If you like long, fantastic, in-depth analysis, welcome to the show, sir. Welcome to MacroEdge Radio.
Thank you so much, John. Pleasure to be here. I'm sorry I got here a couple of minutes late. I just wrapped up my afternoon live stream. So hopefully some people followed me over. I gave you guys a plug while I was over there. But I agree with what Mr. Awesome was just saying. I think there is no chance that unemployment is just going to stop on a dime. There's no business out there that was about to lay people off that's saying, oh, Jay Powell said 25 basis points, so I'm going to keep these people on payroll. That's not going to happen. It's not going to change things. And, the easiest way to tell, I've been saying this on my channel for a while. I think this whole narrative of tightness in the labor market for the entirety of the last 2 years has been just straight up BS. I think it hasn't been tight, even when all these magnificent jobs were being created before they were magically revised down. It's been pretty obvious. And the easiest way to tell is wages have not kept up with the pace of inflation, right? Only in the last few months have wage gains even been higher than CPI, which I think most people would agree CPI is artificially low and that the Fed undercounts, or the BLS undercounts inflation numbers. But wages have been going up slower than everything else. And if supply and demand were out of whack, if it really was a seller's market in labor, then the price of labor wouldn't have been getting cheaper relative to everything else. The price of labor would have been getting more expensive than housing, than food, than cars. But that wasn't happening. Labor was actually getting cheaper relative to those things. And that doesn't happen during a shortage scenario. So, I mean, the basics of supply and demand this whole time have been telling us that the labor market has not been tight. It just doesn't add up.
I'm going to go with you 110% on that. I'll let Mr. Olson jump in here too, because I look at it like this. You're double counting. You're counting part-time jobs and multiple job holders as new job creation to juice the numbers. Then you get these massive revisions like we saw this past week, which was nonsense. We all knew that was coming. We've seen these seasonal adjustments, and the birth-death model seems to be an antiquated guesstimation, just planting numbers randomly into the system to emulate job growth. So people are making multi-billion-dollar decisions, investing decisions, based on faulty data, be it housing, debt projections, growth, employment, etc. And there are consequences for this when it blows up.
Yeah, I agree with that statement. And, I've seen Danielle DiMartino Booth has done some pretty good commentary on the birth death model, basically being used to overstate job creation. And I've also heard the excuse that these revisions was because, the revisions doesn't count the illegal immigrants. And well, there's some truth to both, right? Illegal immigrants don't receive unemployment benefits, or at least they're not supposed to. And so, the revisions to the jobs numbers, that's based on state unemployment rolls. And if an illegal immigrant comes into the country and displaces a native born worker, which we know for a fact has been happening, you can see that in the non-farm payrolls reports in table A7, the numbers don't lie. But when somebody comes into the country and displaces a native born worker, that native born worker goes on the unemployment rolls. So then a year later, when they come and do the revisions, they see this big spike in the unemployment rolls. And they say, well, then the jobs created must have been fewer. And so they start revising it down. So I think both arguments hold water, that both the illegal immigration is leading to this big downward revision and the birth death model. I wouldn't really be able to quantify and say which one. I can tell you the numbers are huge. I mean, if you look in table A7 of the non-farm payrolls, I think I was just talking about the numbers here. The workforce of foreign-born workers increased by 1.648 million. 1,648,000 in just the last year. And the native-born workforce actually shrank by 279,000. So you're talking about new labor supply of 1.3 million people was imported into the country. So, I mean, you want to know why your wages aren't going up to keep pace with inflation. We're importing massive amounts of labor supply. And that massive amount of labor supply is bringing with it additional demand for necessities like rent and food. So they're also chasing those items and driving the prices of those things higher. So if you wonder why the wealth gap keeps growing up, or keeps getting bigger and bigger, that's a pretty good place to start. I mean, I know we're not supposed to talk about that. It's a very emotionally charged subject and people's feelings get hurt, but numbers are what they are.
We're not shy here, as Mr. Awesome will tell you, listening to me now for several months. Mr. Awesome, please ask any questions you'd like of our guests, because let's be honest with it. Numbers have no emotions, and they're either facts or they're not. And deliberately publishing misleading numbers leads to malinvestment, period. Mr. Awesome, take it away.
Well, I couldn't agree with that anymore if I had to, especially in regards to malinvestment. Maybe just on that topic, Jack, what do you see out there that are some of the biggest malinvestments that you witnessed in the markets, and where do you think things are going as time moves on and the economy moves closer and closer to recession, if it's not already in it?
Are you telling me you want to talk about AI, Mr. Awesome? Because that's what you're going to get.
If that's where it's at, yeah, I do.
Yeah, you want to talk about malinvestment. I mean, we just had big tech earnings about a month ago, and every single big tech company basically said, we're going to continue to invest tens of billions of dollars. Right? Google came out and said 13 billion in CapEx this quarter, plus 12 billion in each additional quarter for the next year. Meta said the same thing. Microsoft said the same thing. None of these companies have reported any earnings growth from these AI investments. Some a little bit in Microsoft and a little bit in Google from their intelligent cloud, right? But that's really their investments in these companies, just handing them their own money right back. But none of them have really seen any earnings growth at all from these investments in AI. The CapEx numbers are staggering, tens of billions of dollars. And every single one of the companies came out and said, I'm paraphrasing here, but yeah, we know we're not making any money, but we're going to keep doing it because we don't want somebody else to do it. The risks of not doing it are more. Everybody's jumping off of this bridge, so we better jump off too. None of them have a plan to monetize it. There is not a single profitable AI company in the world right now. Even OpenAI still burns cash at a ridiculous rate. They're probably, I mean, there was a story going around in the information about 2 months ago that they could be bankrupt by the end of this year without another capital raise. So, talk about malinvestment. You got a bunch of companies that are saying, yeah, tens of billions of dollars. We're not quite sure why, but everybody's doing it. So we better. If that doesn't meet the definition of malinvestment, I don't know what does.
Well, Jack, I'm going to go right in there, right by this, and I'm going to tie Mr. Awesome into this. Murtaugh, please stand by. We'll bring you up here in a few minutes. This also brings the malinvestment of what I like to call a repeat of the real estate mistake. And at this time, I'm wondering, are we not seeing what's happening, not in the 07-08 parallel, but the ballooning of private equity investing in homes? And Mr. Awesome is ready to address this. Believe me, he and I were going back and forth about this earlier with the new home sales numbers. We sold 67,000 new homes in the whole country last month, but they always use the seasonally adjusted annual rate to blow it up and make it sound like something dramatic. The truth is, once you take out the real numbers, take out the investors, take out the backed out. The story today, we had a record number of home buyers backing out of deals. That's mom and dad. That's not investors, but generally speaking. But 29% of all single-family homes sold in Miami were investors. I don't see a happy ending for PE. And I think that what's going to happen is we're going to end up having to bail this out again. Mr. Awesome and Jack, please jump in.
No bailouts. I'll start there.
Go ahead, Mr. Awesome. You can take first crack at this one.
No, actually, I'm much more interested in hearing what you have to say on it. That really is kind of my viewpoint on. I'll add on to what you have to say.
All right. So private equity, I mean, we're talking about a pretty big umbrella when we talk about private equity. There is no shortage of, we'll say, potential black swans out there with private equity. I've been seeing a lot about this net asset value financing. The IPO market, I mean, we're outside of housing now. Let's just talk about startups, a lot of them in tech, right? The IPO market has been a freaking desert for the last 2 or 3 years. And what are these companies doing? IPOs is how they normally cash out, right? That's how they get the capital back to go out and make new investments. Well, there's no IPOs. They can't sell these companies. Why? Because they're not worth what they hold them on their balance sheets for. They wouldn't get enough money for them, so they're not selling them because they won't have any investors if they IPO these companies right now. So they're just doing this extend and pretend game. They're taking out net asset value loans, which is basically they're borrowing against their portfolio companies, and then they're using those borrowed proceeds to pay out dividends to their investors, to their general partners. I mean, that's dangerously close to a Ponzi scheme. It's not quite a Ponzi scheme because you do have underlying businesses here. But those underlying businesses, most of them aren't profitable. Very few of them are cash flowing. Some of them don't even have freaking products yet. And they're borrowing against these companies to make their funds look profitable. And then you had, there was a story just this week. Texas is pulling tens of billions of dollars out of private equity investments because they read the writing on the wall. And then on top of that, these guys are like, oh, the mortgage market isn't so good. Well, we're not a bank. We don't know the first thing about being a bank. How hard could it be? We're going to start issuing private mortgages. And we're all sitting here like, yeah, that's going to end well. That's going to, you guys aren't a bank. You don't know anything about being a bank. And I think that's those two things right there, the NAV financing and the private notes, which, by the way, Melody has done an excellent job covering the defaults in the private notes. The numbers are surprisingly high there. I just think that's going to end in disaster.
Go ahead, Mr. Awesome, because once I start this rant, y'all might just cut me off.
I'm going to have to concur with Jack. I actually just shared a Financial Times article highlighting a little bit of what he was talking about. Some private equity firms not able to exit and having to keep their assets a little bit longer. I've long thought that the mortgage market has been distended, and it's one of the things that happened post GFC was banks were basically not even able to lend up until 2013, 2014 again, the way that they were. They were still losing money on assets. The first part of the decade was basically cleaning up the resulting foreclosure crisis that they had been dealing with. And so private equity, however you want to define that, stepped into lending in their place. And it's an entirely different business model. And I think there's risk there that I wouldn't even be able to assess because it's opaque. But I will say, back to your original point, I am not in favor of bailouts for any of that, right? I mean, we've all got to deal with the consequences of our actions, and sometimes they suck. That's life.
Well, my opinion on this, and I'd love to hear Jack's opinion on this also, and yours also, Mr. Awesome. And I'm going to throw this out. This time with private equity, and by the way, folks, before you say private equity, it's a nebulous idea, but it's been there forever. It's part of capitalism. But when you have Kim Kardashian starting a PE fund, yes, she has one, Sky, and it's not going anywhere, and they start investing in products, real estate, IPOs, as Jack said, the risk is not just borne by the investors because you can get locked in. So if you're locked in a private equity investment and you can't get your money out for 5 years, or it loses money, shuts down, and you only get a percentage back, you have to sell other assets. And the kind of people who have the money to drop 1, 10, 15, 20 million into a PE fund have a lot of other stocks, have a lot of other bonds, and they have to liquidate them to meet or keep their wealth generated. This is not a game, folks. These kind of things blow up in the background, and you don't hear about it until all of a sudden a large money center bank says, hey, we're calling in some loans on XYZ. We loan to this PE firm. You have to make it whole. And that's how these stock events suddenly happen. Liquidations, no warning, no notice. You can't log into your Robinhood account. You cannot log into your E-Trade account, and the little baby's laughing at you on the screen while you lose 30% of your equity value. Go ahead, guys.
I just want to comment on two things, and then I'm going to let Jack step in and take it from there. But one, I'm not even saying private equity is a bad thing. I think there's just risk that's there that can't be quantified in how a lot of the funding in private mortgage markets have worked. And secondly, to your other point about, well, I'm going to stop right there and I'll come back to it. I'm going to let Jack chime in, but I just want to throw that out there that I just don't believe that we should be bailing out, businesses when things go bad. So
I 100% agree with that sentiment. Bailing out businesses when they go bad just incentivizes bad decision making, and then we act surprised when those bad decisions get made again. And to that point about no bailouts, not to change the subject, but we had this big thing that we did after the GFC. We called it Dodd-Frank because we said no more bailouts. We said too big to fail. It was unpopular. Everybody hated it. We're not going to reward bad investments and bad decision making anymore. And we passed Dodd-Frank. And they left a little back door in Dodd-Frank. They called it the systemic risk exception. They left that in there for bank failures. And they said, okay, we're not going to bail out the banks anymore. Bail-ins is going to be the thing. If you have uninsured deposits, you're going to be a shareholder in the bank when it fails. But just in case that bank represents a systemic risk to the economy, here's this little exception clause where we can evoke this. And then, okay, now it's a bailout. They have used that systemic risk exception every single time a bank has failed since that's happened. Even I just did a video about this on my channel. Even Heartland Tri-State Bank in Kansas is a tiny little bank that failed last year. Nobody had ever heard of it. It failed because the CEO was a scumbag and he got caught up in a pig butchering crypto scam, and he embezzled tens of millions of dollars from the bank and his local church and his investing club. And of course, that failed the bank. But they never mentioned anything. They called that a systemic risk. The FDIC, again, they threw out Dodd-Frank. They bailed out the uninsured depositors. This bank only had $130 million in deposits, in total assets. I'm sorry, not deposits. $130 million bank was declared a systemic risk to the economy, and therefore it was bailed out. And then in the same breath, the FDIC told us our banking system is strong and resilient and well capitalized. One of these two things is a lie. I don't know which one it is. I'm leaning towards the strong and resilient thing is a lie. But should we bail them out? Of course not. But bailouts are becoming more normal. more normalized, even though we passed this big law that said we're not going to do it anymore. We all congratulated ourselves. Yeah, we're going to hold Wall Street accountable. Man, they threw that out the second things got tough.
Well, that's where I'm going, because what most people don't understand is a lot of the hedge funds and investment houses under those quote unquote systemically important banks are loaning to PE. And that's what's terrifying, because it's totally opaque, totally unregulated, and some of the leverage ratios are north of 15-1. This does not have a happy ending, guys.
I agree. And, if $130 million in assets, little bank in Kansas, is a systemic risk, then what is a Blackstone? I mean, I don't even know what Blackstone's assets under management are. It's got to be in the tens of billions. What are Starwoods, Brookfield, all of these guys, right? All of these funds that are doing everything in their power to avoid price discovery, all over in commercial real estate. Oh no, extend and pretend. They're private companies, they're startups, extend and pretend. So if this little bank in Kansas is a systemic risk, that they're already telling us they're going to bail them out. I mean, I hope they don't, but I'm pretty sure they're going to.
Well, Blackstone's worth $1 trillion AUM as of the end of last year. $1 trillion. For any perspective, folks, look at the GDP of the United States minus the government spending. That makes it systemically important. I don't care what anybody says. And that means that they will find a way to bail these companies out if they screw up, which we've seen evidence that they've screwed up. That brings us back to the real estate part of this. But I'm going to let a guest come in here real quick. Murtaugh, if you have a question, please speak clearly, address it to whoever you'd like to, sir.
You're on mute, Murtaugh.
It was earlier regarding labor market. I was thinking about how job openings. We have 8.18 million job openings in the United States, and how many of those job openings are real? How many are just left posts that didn't take down, or post that the company forgot, and the company that have the post, they are not incentivized to take it down. And also, doesn't all the job openings get more filled as more people come into the country at a higher pace?
Anybody want to tackle it before I do?
Yeah, I think you can very easily see that in the JOLTS report. If I had to guess, if I had to put a number on it, I'd say it's somewhere around 2.5 to 3 million of those job openings are just outright fake or duplicates, work from home jobs that are being posted in multiple different cities for the same job. So when you fill that job, or when you take down that posting, 5 to 10 postings go away. I mean, if you look at a chart of the JOLTS numbers, the job openings and labor turnover survey, if you look at a chart of those openings, you can see this massive step change that happened right at the onset of 2021. It was about 3 million. Some of that was real jobs getting posted, and some of that was just the work from home expansion. And some of them are ghost job postings. People are just leaving the posting there just in case an overqualified candidate comes along and they have an opportunity to hire them for a cheap wage. But I mean, we're still measuring job openings the same way we used to pre-pandemic, and we work differently now, and that hasn't been factored into this. So if I actually absolutely had to put a number, I'd say about 2.5 million lower than what JOLTS is saying right now. And right now, JOLTS is saying about 8.2 million. So we're probably somewhere closer to 5 million.
I'm going to toss it here, Murtaugh, just to help you with this. CNBC actually had a flash of journalism yesterday. And much to our shock, they had a story about ghost jobs. 40% of all job postings are ghost jobs, 4 out of 10. And another estimated 2 out of 10 are questionable, like Jack just said, stale jobs that were left up. What you have to understand is a lot of the job postings you see that JOLTS counts in their methodology, which is why I've been extremely critical of the methodology with the MacroEdge crew and telling everyone, do not use JOLTS as a standard. The jobs are posted on a newspaper site, a message board, or one of the job services duplicated on another one as an original listing and double counted. So I agree with Jack. We're probably close to 2.5, 3 million jobs that are total nonsense being posted on any given week. And that really does illustrate that the labor market has been under stress for more than just the last 6 months, probably going back to the pandemic time.
Yeah, thanks for clarification there. So we have about what is it? Unemployment level 7.16 million unemployed persons and about 5 million job openings, and rapidly declining.
Correct, and Jack will probably back me up on this. The BLS methodology does not, I repeat, does not count people who have dropped out of the workforce due to frustration. If you don't find a job within 9 months, they just assume you've gone away. You could still be looking for work, especially in some regions of the country that have difficulties in bringing people on. And that distorts the figure. If you lower the number of people seeking jobs, you lower the U3 and U6 unemployment rate. Jack, you want to add on to that?
Yeah, I was just going to mention U6 is probably a better indicator, but even that has its flaws because, you know, they create these obscure reference points like people who are still marginally attached to the labor force. I don't know what a marginal attachment to the labor force even is, but there's a lot of flaws in the way we count unemployment. I agree with that. The one thing I would say to keep an eye on when it comes to the unemployment numbers, besides the absolute level that they get reported, is keep an eye on this growing delta between the household and the establishment surveys and the unemployment numbers. And, you know, I don't know if I'm over explaining this or not, but, you know, every jobs number, every jobs report, there's two different surveys. There's the establishment survey, which is the jobs number that you hear about, how many jobs were created. That counts positions filled. And then there's the household survey that counts people filling positions. And you'd think it's the same thing, but it has been wildly different for the last 3 or 4 years. And the gap has been growing. And the fact that we got this big downward revision just 2 days ago, that 818,000 jobs that went away, that's telling me the household number has been more accurate than the establishment survey. And the household numbers have been terrible. That has been showing losses of millions of full-time jobs, partially offset by gains in part-time jobs and people getting second and third jobs, and a lot of gig work. You know, OnlyFans, Uber drivers, like, you know, that's not economic prosperity. That's desperate people doing whatever they have to do to eat.
Well, I'm gonna throw this out right now. We're seeing desperation because people are taking the gig economy jobs, and that right there tells me more than I need to know. When you think that a full-time job is Uber or DoorDash, etc., it's not the same, folks. And you have to understand, this isn't a career move. It's if you're doing it semi-retired to fill in the income gaps, that's one thing. But if you're doing this to sit there and maintain some sort of income in your household to keep your house or whatever, it's going to end in tears. And that's the scary part about it. I think we're going to see the consequences of this, and we're going to get into the housing part of it in just a minute. Jack, why don't you plug DNN and your morning and afternoon broadcast real quick before we move into this?
Sure, and thank you. DNN, or the Doomers News Network, that's my new joint project with Melody Wright and Travis from Real Estate Mindset. People call us Doomers, and I think it's meant as an insult. And I just said, well, you know what? All I do is I look at the numbers and I say all this positivity in the mainstream press is baloney, that CNN and Bloomberg, these guys are little more than cheerleaders at this point. And they have to be, because their income is determined by selling advertisements to mostly the financial services industry. And the financial services industry wants everybody to just keep passively handing their money over to them to manage. So telling the truth about what a terrible job they've done managing that money isn't really in CNN's best interest. So no matter what, you only ever get lipstick on that pig over there. We don't have any of those conflicting interests, so we just call it like we see it. And if that makes us Doomers, we'll embrace the name, no problem. And so that's why we call ourselves the Doomers News Network, is because nobody is out there calling it like they see it. Everybody is just trying to make things sound as good as they could possibly be because they have conflicting interests. So Travis and Melody do an excellent job. I'm happy to be working with them. And then my channel on YouTube is Nobody Special Finance. I do a morning show every morning at 9 a.m. Eastern time. Just go through what's the big financial news of the day. What are people talking about? What are the stock indexes doing? What's the bond market and commodities doing? It's usually about a half hour long. And I do that every day.
Fantastic. And just to plug our side of it, MacroEdge.net, Ozone. Sign up now for a 2-week free trial, MacroEdge.net. We have a very active channel. The MacroEdge Radio project is designed to bring you guests like Jack and like many others that we've had on the past to give you alternative viewpoints to make the correct investment decisions. You want to hear the truth, or you can hear plugs for stocks that are doomed to blow up in your face. And if anybody says one more time to me that NVIDIA is not Cisco, you may politely go to hell. All right, Mr. Awesome, you have been working on some fantastic charts for real estate. I'd like for you to share that with Jack and bring into the conversation what your perspective was on the new home sales report this morning. And let's start that up because I think that's part of the bubble, not just with PE, but because of the problems with individuals making ends meet, that's going to hit very hard in 2025.
Sure. Thank you very much. I am going to post a thread underneath the spaces and the responses here for anybody that wants to look at the charts. Yeah, I have been in the home building world for quite some time. The last couple of years have been writing and doing research for MacroEdge, as well as private clients outside of MacroEdge. My full-time business is uspropertyservices.com. And one of the things that I have wanted to do for quite some time is put some clarity onto the sales numbers. We talked about this month, they were fantastic sales, and they were pretty good, all things considered. But then we hear things like, well, interest rates are a huge part of it. We talked about pricing and inventory, whether it's high or low. So what I really wanted to do was create an index that would take into account all those things. And I did that. So this is a 4-part equal component. And it's made up of what the number of sales every month are, what the amount of inventory is, that's all of the for sale single family homes, the percent change in the 30-year mortgage rate, and then the pricing direction based on a percent change from a year ago level in the median sales price of a new home. And the reason why I chose that is because there are fluctuations every month on home prices. But if you look at it from that perspective, you get a very clear delineation of where home prices are going. Is there price impairment or price expansion? Price impairment, if you're a manufacturer of anything, is never a positive thing, right? You're not able to increase your prices. And it's especially detrimental if there's an impairment and you're having to decrease them. So that's what this is based off of. And yeah, I published it last night on my website and shared it with the world this morning. And so while we had great sales, the index is actually pretty low. And the reason being is we have way more inventory than we normally would in the home building cycle. And I also identified all 9 building cycles going back to 1969 for new single family homes. And I have clarified what those are and why the cycles are marked the way that they are. So even though we had some interest rates improvement in the 30-year mortgage, and even though we had better sales, building still isn't out of the woods yet. And this isn't a thing about doom. This is something where builders can look at this and say, hey, if we've got this much inventory more than normal, let's focus on moving the inventory before we start putting anything else in the ground. Let's not take one great month of sales as everything's changed, because it doesn't change the picture entirely. It just changes the short-term picture.
Well, Jack, I'm going to bring you in now because what I looked at, and Mr. Awesome and I talked about this earlier today, the data reflects sales levels non-seasonally adjusted, which is my favorite point of analysis for any data. We're at levels not that are parallel to 1977, but the population is 34% larger. I see a problem here. Do you?
Very much so. I mean, look, you want to adjust for population, we should be a hell of a lot higher. I mean, almost double, right? I mean, what was the population in the 70s? Somewhere around 200 million, 220 million.
The data, the number is 222.8 million people in 1978.
I was pretty close. That's good enough for a stick of dynamite.
Close enough, sir. Absolutely.
Yeah. So yeah, I mean, obviously we should have far more sales than we're getting. I like the fact that I'm guessing you add inventory as some kind of denominator in this equation. Since you're talking about the number of sales, you obviously have to put that in the context of what does that look like as a percentage of inventory. So that's good. I think the math checks out there that you correct for inventory size. And I'm just looking at these charts that you sent me, Mr. Awesome. And, I see this in so many other charts as well, especially the unemployment charts. If you take out that blip down and then the spike up after COVID, I mean, where your index has it, it's right where we should be based on a continuation of the trend we were seeing in the aftermath of the GFC. I mean, I'm looking at your index right now. We peaked right around the end of 2012, and we had been declining ever since. And then COVID happens. Obviously, the index skyrockets because of the helicopter money and the stimmies, and then it overcorrects down. But now here we are, pretty much right back in that trend line that we were in for the entirety of the last decade.
Yeah, it's interesting, isn't it? Now, one of the things, given that this is a situational index, when it peaks like that, right? Those are basically, if you're a builder and you want to look at this as, hey, when's the best time to be selling a house? Building and selling houses. It's when that peaks. So that's the best time. It's when the conditions are the most favorable. There's the least amount of inventory out there. Price direction is expanding. Rates aren't hampering your sales. Unfortunately, what usually happens cycle after cycle is builders go, hey, sales picked up. Let's build more. Let's build to meet the demand, rather than looking at it as a way of going, hey, if we just moderate it here, this whole supply thing is actually playing in our favor. Maybe we shouldn't just go to town and make hay while the sun shines, so to speak, but just maintain a healthier pace of building and selling.
Well, go ahead, Jack.
I wasn't going to chime anything else in there, but I would also just add that I think lumber futures are supporting what this home building index is telling us, that this is not a good time for the builders. I mean, lumber futures down another 2% today. They've been falling pretty well. They fell pretty hard in March. It looks like they're resuming lower again. So I like this index. I like the new math, and I think this is a really good chart.
Thank you very much.
Well, Jack, my background is more of a history and logistics background, so I'm going to throw this out to you because we're hearing the stories from the larger mass media, the ones you love to have on DNN to have fun with. They are proclaiming that all of these imports hitting our docks now, 60 to 90 days ahead of schedule, is a bullish indicator for future economic activity. My counter argument is that they're bringing everything in for Christmas ahead of the projected strike 2 weeks before the election. And I have the funny feeling we're going to see more pain inflicted on retail because they brought all this inventory in, and sales will not be as good as they project because, 1, layoffs, 2, employment declines, and 3, the inflation, which has increased dramatically over this past 5 years, is still sustained. We have no deflation. So the affordability to go out and have a big Christmas, the access to credit, et cetera, 80% of the American public is going to sit there and say, hey, I'm not spending as much. I can see some real liabilities hitting in the fourth quarter against not just the retail sector, but transportation again, and of course, the credit card companies who are going to get stuck with the bills.
Yeah, logistics is interesting right now because, we're expecting a strike on the East Coast and Gulf Coast ports here. So you're right. I'm sure some people are moving up their seasonal deliveries to try to get that stuff in before that hits. You've also got the Canadian rail strike going on right now. I don't know that that's going to affect holiday retail that much, but it could. And then even today, if things are supposedly so good in logistics, and that's a sign of health in the economy. You had Universal Capacity Solutions just abruptly shutting down today. It's been kind of quiet, the logistics space. This time last year, we were talking about yellow trucking going under. That was a big deal, and a lot of these small-time carriers were going under. And then that kind of faded from the headlines. A lot of people thought maybe the logistics recession was over. And then, of course, that story today tells me maybe not. Now, last year, a lot of people were expecting very lousy holiday sales, and they actually ended up being okay. I want to say okay. They weren't good. But the big surprise was buy now, pay later. Buy now, pay later exploded in popularity last fall. Affirm and everybody started doing this. So we already had maxed out credit cards. We're over $1 trillion in credit card debt in the country, and credit card rates are unsustainable. And then all of a sudden, this new form of consumer debt comes out. And lo and behold, we have a good holiday shopping season because everybody put it on BNPL. I don't know that that's going to be there this year because everybody ran up the credit cards, and then they ran up the buy now, pay later. And then we saw the travel wasn't so good this year. All the hotels are doing lousy. The restaurants are doing lousy. Disney World is doing lousy. Serves them right. But, the travel stock's not doing so hot. And so people already cut back on vacations. There's two ways you could look at that. They cut back on vacations because they're broke. And so it's going to be a lousy holiday shopping season. You can already tell they took less vacations this year. Or maybe because they didn't have the vacation, they're going to have a little extra cash to spend on Christmas. That could go either way. I'm leaning towards the first, that they're just broke, and so they're not going to have any money to put on Christmas. And man, watch out for that buy now, pay later crap. I'm telling you, that stuff, I've seen the research. The controller of the currency says the average buy now, pay later user has a credit score that's below 640. And actually, I think they said it was below 580 to 640, which means the average buy now, pay later user has subprime credit scores. And we're seeing delinquencies rise in virtually every category of consumer debt, with the exception of student loans. But student loans, it's still illegal to report delinquencies, so I'm not surprised that one's not rising. I've heard numbers as high as 40% of student loan borrowers are still not making payments. So you've got a firm CEO is out there in the press saying, don't worry, buy now, pay later delinquencies, they're 2.4% and steady. When delinquencies in credit cards are already starting to push 10%, delinquencies are rising in home equity lines of credit, delinquencies are rising in mortgages, auto loans, everything is rising. And yet here's this CEO telling us these borrowers who have an average credit score of subprime and these loans that are not secured by any collateral, there's nothing to repossess, that these people are paying us back when they're not paying their house, they're not paying their car, they're not paying their credit card. Something doesn't add up here. I think buy now, pay later is going to be a lot of debt going up in smoke. These companies are securitizing that debt and they're selling it to investors, and it's getting 80% AAA rated. I mean, where have we seen this movie before? So I don't know that that's going to be there this time around this season. I don't think the buy now, pay later people are going to be able to spend like they did last year. They're already up to their eyeballs in debt.
100% agree. And the buy now, pay later people are now having to deal with the Consumer Financial Protection Bureau submitting their credit to the same rules and regulations as credit cards. And that is supposed to take effect October 1st. Guarantee you it'll be delayed till December 1st after the election. Trust me on that one. But that will have a major impact on their access and availability to credit and the BNPL scheme. The other thing I'm looking at, and I want you to understand this, the transportation industry is showing a little bit of sign of life, but you're not hearing about the mom and pops. And there's a great story out of Massachusetts. This is one that will really blow your mind, Jack. This one is beyond belief. They are banning the sales of diesel trucks in Boston, Massachusetts. Think about that. You have to have an electric vehicle to operate in Boston by 2030. What will that be as an inflationary impact?
Now, the interesting wording there is they're banning the sales of those diesels. Are they also banning the use of them?
After 2030, yes.
Oh, that's going to be hilarious. So you're going to have a lot of cargo sitting on the Massachusetts border because the diesels are going to drop it off there and say feel free to come pick this up in your Cybertruck whenever you're ready for it.
Same thing is going to happen to California, because California's implemented a new exhaust standard for diesel trucks that 80% of interstate trucking cannot meet. There are a lot of things being implemented regulatory wise that people don't see until the price of their groceries double. And they say, oh my God, it's those greedy corporations. Let's go full circle back to that. We've heard the proposal of price controls. Those of us old enough to remember the 70s, God help me, know what that means. What is your quick take on the concept of price controls on companies that have a 2% margin?
I don't think I'm going to get very academic about this one. I'll just call it what it is. It's communism, and it's stupid. And anybody with the capacity to open a freaking history book or Google can see what happens. Venezuela, Cuba, Soviet Union. I mean, Boris Yeltsin came to this country after the collapse of the Soviet Union, and he went to a supermarket, and he was in tears. He couldn't believe there was 30 or 40 different kinds of freaking bread for sale at an American supermarket, because everybody in the Soviet Union had to wait in line for whatever the heck the Politburo decided they were going to put out that week. This is stupid. It's pandering to economic illiterates, and we need to have higher standards in this country. I'm going to go a step further. They're already trying to walk this back, thank God, because even our ridiculously in the bag for Kamala financial press called out the stupidity of price controls. So now they're trying to walk it back, and they're trying to say, oh, no, it's not price controls. We're just going to ban price gouging. It's the same thing. All right. It's the same freaking thing. Oh, we're not going to control prices. We're just going to put a limit on how much they can go up. Well, that's a price control. Congratulations. You said the same thing using different words and taking up more time on the air. You just sound stupider than you did a few minutes ago. And I'm going to go a little bit further to say that there's actually no such thing as price gouging. I catch a lot of heat for this because price gougers are generally loathsome people and they take advantage of people. I get that. But you know, I got my little chicken operation in my backyard, and my girls have their little side business. They sell eggs sometimes if the chickens are having a good week. My girls can't go out and sell eggs for $25 a dozen right now. Well, they could, but they wouldn't sell any unless there was an extreme shortage of eggs. All right, so price gouging only works during times of scarcity, during shortages. And so yeah, you can go ahead and try to price gouge, but the free market's going to put you out of business unless there is some kind of market dislocation going on, unless there is an extreme shortage, in which case price gouging isn't greed. It's the market telling you something is majorly wrong. There's an extreme shortage and new supply needs to come online fast to make up for this shortage. And so if you ban price gouging, all you do is create more shortages because you're eliminating any incentive for new supply. All right. And this is basic supply and demand economics. And the fact that we've got a presidential candidate pushing this, in my opinion, is more a condemnation of our public education system than anything else, because a fifth grader should know enough about economics to know this is stupid at this point.
Mr. Awesome, any more questions? Because we're going to wrap this up and keep it nice and tight for an hour to be polite to our guest and to sit there and keep the MP3 cleaner. I think I found a new way to fix this stupid system that X Spaces has developed. Do you have any more questions, sir?
No, I just want to thank Jack for the time. It was a great conversation, and thank you, John, for the conversation.
Thank you, Mr. Awesome. Jack, I've got one for you, because one of my biggest beefs has been the financial media promoting this illiteracy. Yeah, I could probably go on a half-hour rant about that, but I'm going to keep this short and sweet. What do you think the impact of X, FinTwit, etc., and alternative media is on people getting a better education about what's happening behind the scenes? Most people do not understand what the term leverage means, much less what happened in 2008 or 2000 or 1929 or 1893 or 1907. It's insane. And the lack of education on those subjects is amazing.
Well, I can tell you the people who are responsible for teaching these subjects tend to be of a certain thought, a certain school of thought, we'll say. And those are the same people that control most of big tech. And they're the same people that control most of the media, both entertainment and news. And they're the same people who control most of the TV. And so I'm not surprised that this massive hole for accurate financial information has grown. And these institutions, through their stupidity or whatever it is, greed, stupidity, corruption, take your pick, they've created their own competition. All right. People like me shouldn't be able to just pop up a YouTube channel out of nowhere and start making a living that way, unless there is a massive hole in the market that's been created by the press abdicating their responsibility. I mean, the press, their responsibility is to be the watchdogs of power, whether it's government, whether it's banks, financial elites, and they are no longer doing that job. They're actually in the bag for those financial elites. And so, stories like that little bank in Kansas being declared too big to fail. Nobody, not at the Wall Street Journal, not at Bloomberg, nowhere, nobody asked that question. Why are we doing this? Why are we bailing out uninsured depositors at this little tiny rural bank? And nobody asked the question. They should have asked the question, why are we bailing out the depositors at Silicon Valley Bank? Why is a bunch of big tech venture capitalists who right now are making billions of dollars inflating AI stock prices, why did we bail them out? Why were they a systemic risk to somebody who lives in flyover country that's just working a 9-to-5 job? Nobody ever made the case. There was no explanation. We just decided, oh, well, for your own good, we're going to dip into the deposit insurance fund and bail out these rich people. Trust us. It's for your own good. These are very complicated things. And, that is not the truth. It wasn't for their own good. It was actually at their expense. And so people like MacroEdge, people like YouTube channels call them out on this. And the financial press actually, instead of adjusting their take, now they do things like, oh, we need to get Twitter banned, or we need to get Twitter censored. We need to label this misinformation and get it shut down. So now the press, the people whose job it is to speak truth to power, are actually carrying the water for power, embracing censorship. And in my opinion, they are the biggest purveyors of misinformation now.
Isn't it amazing watching people to sustain a price on an equity, a bond, or other investment, the lengths they are willing to go to simply sit there and sell you the latest voodoo medicine, like the sideshows of the 1800s, and no one is held accountable. And by the way, I know I could fire Jack up for another hour with this one. Exactly 0 major bank officers were held accountable for their play from 2005 to 2009. Think about that, folks. If you or I, the average schmuck, the internet personality, the blogger, did something like that, I can promise you the IRS, Treasury, and the FBI would be in our house taking our computers and hauling us off.
Amazing. Nobody went to jail. Oh, and speaking of, endlessly pumping in equity. All right. I'm gonna pick my favorite punching bag here, NVIDIA. All right. I'm not going to go over the whole quote, but do you guys remember the quote? What were you thinking about Sun Microsystems? Somebody made the comment like, don't say NVIDIA is not Cisco. Let's talk about Sun Microsystems for a second. They were trading at 10 times price to sales. And their CEO, after the company had already collapsed, had a very famous quote where he's going and saying, I'll paraphrase it here, but if I had paid every single dollar my company took in revenue in the form of a dividend, I paid nothing to my employees, I paid no taxes, no utilities, no cost of goods sold. Every dollar the company takes in revenue, I give to my investors. It still would have taken 10 years to pay you back for what you were paying for the stock. And he ends with, what were you thinking? This is a CEO saying this to his own investors after his company had already crashed. That was Sun Microsystems in the dot-com bubble at 10 times sales. NVIDIA is trading at 40 times sales today. So no, NVIDIA is not Cisco. NVIDIA is so much worse than Cisco. NVIDIA is 4 times as bad as Sun Microsystems, and Sun Micro was worse than Cisco was. So we have never seen valuations like this. But you know what? Out of 37 analysts that are rating NVIDIA right now, 4 hold ratings, 0 sell ratings, all the rest are buys. There is not one sell rating on NVIDIA at 40 times sales. You telling me these guys aren't in the bag, there isn't some groupthink taking over Wall Street right now? Oh my God.
Well, on the good news side of thing, Apple's getting ready to come out with a new phone that has all the latest advancements from the Android via Samsung 5 years ago. Please, Jack, plug your website, plug your FinTwit video program, and plug DNN one more time for our listeners so they can tune in and hear some reality. We appreciate your time today. I think this has been fantastic. If you're welcome to it, we'd love to do it again, or bring the whole DNN crew on, and we can all beat up on real estate for a while, because I think it's about to get a lot worse.
I would love to bring the whole DNN crew on. The one channel is Doomers News Network. We're on YouTube at Doomers News Network. And we're also on Twitter. I forget what the Twitter handle is for Doomers News. Melody runs that, and it's new. Oh, I should know this. I'm delinquent. The other one, okay, it's at Doomers NN on X, Doomers News Network. And then my channel is called Nobody Special Finance on YouTube. Every video and live stream I put out also goes out on my Twitter feed at JG_Nuke.
Jack, thank you so much for your time, and thank you for your input. We appreciate new perspectives and new information, obviously. We're MacroEdge.net. We cover everything. We appreciate you coming here. And, folks, MacroEdge.net/Ozone. Sign up for the free 2-week trial. You're going to see more data, perspectives, and input. Like what Jack said, like what Mr. Awesome says, and like what I write, we try to bring you an alternative viewpoint of reality, where the data and the history and the information is fresh, and you're not stuck with a stale old infomercial with some bald guy throwing plastic bulls at you on a TV screen. For MacroEdge Radio, this is John Galt speaking. Good night now.